Good afternoon and welcome everyone. My name is Mike Tournier. I'll be running today's webinar. We're just going to give it a couple more minutes, allow people to join, and then we'll start the webinar without further delay. So enjoy your cup of tea and a sandwich, and we'll back to you in a minute or so. Welcome to those who joined us. We're just going to let the folk log in. Just going to run another minute, and then we'll start the webinar. So just bear with us. Oh, good afternoon, everyone. My name's Mike Tournier. I'm the carbon guy here at Achilles. Thanks for joining us during your lunchtime. I'm going to take you through the presentation. We've got a couple of polls along the way, and we're going to launch one very shortly. And at the end, hopefully, we'll have a bit of time for some Q&A. And of course, feel free to reach out via email if you have any questions you'd rather sort of share or keep in confidence. So without further ado, I'm just going to turn my camera off, and if we could run the first poll, please. So you'll see we've got the first poll up and running. It's just asking a question around how confident you are as an individual or the organisation on your being ready. Let's let it run about another 30 seconds. And we've got a good 80% have voted already. So that's great. Let's close that poll and let's have a look at some of the results. So results are in. Look, great. We've got 54% are either quite or very confident, which is a great place to be. So well done. About 27% of you are sort of in between, neutral in the middle, and there's about 20-odd% quite concerned about the lack of progress, and that's what we're going to talk about today, about moving beyond greenstalling. So let me just get through the slides. So got a bit of an agenda we'll be moving through at pace, and I believe we'll be sharing these slides at the end, so you have a chance to go back and reflect over them and any questions you have. So look, some background on Achilles. Achilles, they've been operating for some 33 years, as many of you will know, very much managing risk within corporates and within their supply chains, and carbon risk and climate change risk sits within that. So we've been delivering the program for over 16 years. We've done 4,500 certificates. There's millions of tons that have been verified, and it's been a great journey. So let's just look at the current business trends and shifts around climate change and net zero. So first of all, what's net zero? often it means different things to different people at different times. Many different definitions out there. The simplest way I like to try and explain it is, we've got these greenhouse gases in the atmosphere. They're built up over time, particularly since the Industrial Revolution. And our atmosphere, if we think of it like a bucket, the bucket's almost full. And we're at this 1.5 degree tipping point. So what can we do about it? And whilst offsetting has its part to play, it relatively has a limited impact. So the most dramatic thing we can do is just reduce the emissions, and that's the key principle of net zero. It's getting those emission reductions underway to help that transition towards a net zero future. What's happening in terms of the business landscape and the regulatory landscape and voluntary action is that the UK still has a net zero target by 2050. We've got bits and pieces of legislation and procurement sort of requirements, a stick and carrot approach, if you like. So companies of a certain size are required to report their energy and carbon to Companies House. Businesses wanting to sell goods or services to government entities, devolved authorities, NHSs and the like are captured on something called Public Procurement Notice 0621, which requires them to measure and report not only their scope 1 and 2, but a number of scope 3s, and also have carbon reduction plans and be able to report on those. And there's a consultation paper out at the moment around looking to further make that more robust. And then we've got the industry sectors, which are setting net zero targets well ahead of 2050. We've got the water industry, many in the construction sector have set goals of 2030 or earlier, and that's having a significant and positive impact on the move to a lower carbon economy, and it of course makes pressure on supply chains. So tier 2, tier 3 companies are now needing to demonstrate their carbon credentials and their carbon reductions. And then you've got a number of public disclosure platforms such as Science-Based Target Initiative, the Carbon Disclosure Projects, and so on and so forth, where businesses are wanting to put their carbon credentials into the marketplace. Excuse me. So what's that mean? Look, in terms of a good governance and leadership, the fundamentals are year on year the ambient temperature's slowly increasing. It is increasing, and whilst climate change is a gradual process, the risks are wholly irrelevant to the decisions made today. So if you think it in terms of 2050, that's not much more than 25 years away. And if you're looking at making decisions around purchasing plant and machinery that has a life cycle of 20, 25, 30 years, then it really is irrelevant today. So that third bullet point around businesses are able to credibly demonstrate you're managing climate change risk and carbon efficiency, you're going to be more resilient, and you're going to be able to attract and retain customers. So what's greenstalling? In essence, it's being stuck in that planning loop where there are a number of businesses who have set net zero goals, but just haven't been able to move forward and develop any sort of reduction plans. And often they're just concerned that they're going to be criticised, whatever they do is going to be wrong, or they just don't know where to start. So how do we get over greenstalling? Well, the first thing is it's about action. Pablo Picasso said action is the foundation key to all success. So it just means get moving. Planning is not doing, and that's really the key to break out of that planning loop. So where do you start? Appreciate emissions inventories can be absolutely overwhelming. So best advice is it's like eating an elephant. You deal with it one bite at a time. Break it down to bite-sized chunk, often called the salami methodology, where you cut a salami into a whole lot of very thin slices and you just deal with each one at a time. So how do we get there? And that's often the challenging bit. There's so much to do, not quite sure which pathway to take. A bit of a formula may be useful. You might want to try something else, but it certainly works with members in our carbon reduction program. And of course, the other question is by when. So This is almost a Home Alone moment. We find some companies will have set goals around net zero carbon by a certain arbitrary dateline, but there's not necessarily the thinking that's gone on behind on what that means to business and how you're going to get there. There's even brave people who've set goals by 2025. So we've got to deal with it. How do we do that? Well, absolutely fundamental to any reduction is you can't manage what you haven't measured. So the most important first step in a net zero journey is measure your inventory. Get a baseline in place, because in doing that simple exercise, you'll be able to form a view on where the carbon challenges are and also where the opportunities are. Without clear objectives, you're going to be stuck in a constant state of guessing. So measure first, then manage. So what's measured? I'd take almost everyone will be familiar with this classic slide from the greenhouse gas accounting protocol. We've got our scope 1, which is just a quick refresher, is our direct emissions, things like the operation of your fleet of vehicles, managing your corporate head office, things like gas for heating, maybe some fugitive emissions if you're have some more complex processes. Indirect in the UK is relatively straightforward. It's primarily import of electricity to run your business. And then we've got the scope 3, which is excuse me, by far the bigger part of the footprint. We'll look at that in a bit more detail. So getting started, my advice if you're stuck in the planning loop is deal with scope 1 and scope 2 first. All right. It's relatively straightforward. There's normally very good data. We call it primary data. So you know how many litres of fuel we use. You'll be able to ascertain how many kilowatt hours of energy, electricity were purchased. So go through the exercise of measuring your and baselining your scope 1 and scope 2. That'll give you your current state. It'll also give you a baseline to work from and a carbon footprint. Have a look at your asset inventory. This is about setting up for that strategic view down the track around what assets you currently have that are getting near the end of their life cycle, going to be up for replacement. For in there sits the opportunity where potential high impact carbon reductions by bringing more carbon efficient assets into your business as you replace plant machinery. You'll be able to identify quick wins and existing initiatives and how to accelerate that through this process. Also, just with your scope 1 and 2, look at your stakeholder analysis. What's important to them? What are they doing? If you have a large fleet of vehicles and your high energy of fossil fuels, what are the opportunities to transition? May not necessarily mean to an electric fleet. It might be by using a lower carbon fuel alternative such as HVO. And then look at what are the climate risk identifications. What's potentially going to impact on your business? So that's a bit like a TCFD view. It's more strategic. If you can identify those early, just with your scope 1 and 2s, that's going to set you up really well as a cookie cutter to deal with the scope 3, which is often more challenging and why people sort of get stuck. So that leads us really nicely onto what's scope 3 for me, which is your value chain mapping, your corporate value chain. Why is scope 3 so important? Many of you will know this, that scope 3 are by far the largest part of any organization's carbon inventory. They could be 80 or 90% easily. I've seen even higher. I've seen someone in the service industry, in the legal companies, lawyers, barristers, their scope 3 is with the order of 96, 97%. So it is like the iceberg. And that's why people are focusing on it, because this is where the gains are really going to come from, because your scope 3 is someone else's scope 1 and 2, and that's where they're trying to drive these change. There's a lot of catalysts and behind measuring scope 3s. It could be things like the public procurement ISO 621. It could be because of you're dealing with a larger company that has a net zero goal, and of course they're looking at you as part of their scope 3 and looking for reductions. It could also be with, for CDP and SBTI reporting. So there's a number of reasons why Scope 3 is becoming more and more important. So just touch on Scope 3s. They're broadly categorized into two swim lanes. Upstream, which effectively things coming into your business, and then downstreams, products or services going out of your business towards the end user. So in the Achilles runs the Carbon Reduce program, which is a certification program. It's got a helpful sort of guidance of these three buckets, if you like. The program has a minimum mandatory boundary. So when someone's just starting off their journey, we would suggest that they absolutely got to measure their Scope 1 and 2. And there are some Scope 3s they should look to measure. And whilst they're in the supply chain, they're the ones that companies have the most control over. And they're simply things like waste. You can decide what happens to the waste, whether it's recycled, how it's treated, how much waste you have. Business travel, again, you can decide if someone does travel and then by what mode. And then downstream transport and distribution, because obviously there's opportunities to consolidate logistics and get the most out of it. Middle one, quite common here in the UK, it's the Public Procurement Notice 0621 I mentioned before. The items listed in bold there are the ones that you must be measuring and managing and reporting those as part of that requirement. And then last of all, which is very common now with companies who have set net zero goals, is the full Monty. All 15 subcategories of Scope 3 are there. Some may or may not be relevant. For example, if you don't have franchises, you can drop 14 straight away. If you're not an investment or bank or say an insurance company, it's likely you can drop 15 as well quite quickly. So how do you deal with the tsunami of data? Or as I like to put it, drinking from a fire hydrant, where there's just so much information, it's overwhelming. How did we get there in the first place? It's probably been a case of where someone's just collected everything that they possibly get their hands on and just piled it up, and perhaps you're the lucky individual that's just been landed with the boxes on your table. The reality, the key to success with dealing with Scope 3s is the same with the whole thing. It's one bite at a time, salami methodology, whatever way you want to describe it. With Scope 3s, I'm a really big fan of the MBA 80-20 rule. 20% of your effort's going to give you 80% of the results. And so always come back to that sort of thinking. It's so easy with Scope 3s to be distracted, follow red herrings, for want of another term. Follow something that's maybe a personal interest to you, but it's not going to give you that 80% result. So you need to be a bit clinical. For example, if you're in the construction industry, there are known high carbon materials, that's steel, cement, those sorts of elements. They're the ones that's worth spending the time on if you're measuring purchased goods and services. It's going to give you results if you can decarbonize that, versus say looking at one leased piece of plant machinery that you've got in the organization. Excuse me. So another key thing, just to help with greenstalling or avoiding it, is don't sweat it. Perfection is the enemy of progress. You're going to have a lot of uncertainty. In fact, it's going to probably be more uncertainty than anything else you've dealt with. Don't let that stop you, right? Don't get stuck back in the planning loop because you need to do more research. It's about continue to move forward. So what's the key principle with carbon accounting and measurement is primary data is king. And when I say primary data, I mean things like a litre of fuel, a kilowatt hour of energy, a kilogram of cement, something where you've got numbers that are calculated by volume. But dealing with imperfect data, we have this thing called the hierarchy of data accuracy. Now, in an ideal world, everything would be primary, so it'd be supplier specific. Your utility company tells you what the kilowatt hours are. Maybe if you're in construction, maybe your cement provider could give you an environmental product declaration of what the carbon intensity of their cement is. Happy days if they can. But it's quite common you won't be able to get there. So you'll be using something like a hybrid or an industry average, or worst case scenario, right at the bottom is a spend-based approach. And that's where, if all else fails, you can take the amount of money that you spend on a particular activity, maybe let's say it's accounting or legal fees, and you can calculate the carbon intensity of that. And again, 80-20 rule. So this is a good example of where you don't want to start with spend base is good. Over time, you'll be able to improve that. So here's an example of using a spend-based approach on, in this case, it was accounting services that company purchased. In this scenario, they did £30,000 last year. So DEFRA or BIS have what's called a table 13. There's other spend-based tables out there that you can use, but in this scenario, you can calculate the amount of carbon per pound spent, and this calculation comes out at 3.85. Now, handy hint for everyone, if you're doing these calculations, do it excluding VAT. The reason for that is there are tables that do, some tables that do include taxation, but taxation is not a flat rate. So some VATs at 20%, some is at 5%, some's at 0%. So by doing using excluded VAT tables, it just takes away the pain and removes error. Screening is a great idea. And here's a great example of where someone's particularly is looking at their purchased goods and services, which by far for most organizations is going to be the majority of the scope 3s. The first thing you can do is quite simply is look at it by a percentage of spend, and very quickly you can start to see what's the top 20%. Everything with a green bar on here. That's where you spend your time and effort, because that's going to give you your 80% return on time. Great way of filtering. Everything else that's sort of from the bar number 6 or 7 down below, still use a spend base first time round, and they'll just help keep you moving forward. Another good methodology is sort of this step process. We use it in the program, particularly with dealing with complexities of spend base. So you could have a purchase goods and services expenditure. Could be 6,000 lines of raw data. The company's different items the company's purchased in the last year. And what you want to do is you want to first of all is try and account for that both by the monetary spend, excluding VAT, and also by the volume or the mass of it. So if you've got kilograms, you've got liters and things like that, put that in a column in a nice little spreadsheet. And then some exercise you saw is look at your top 10 by spend and by mass. That's going to give you a good starting point to work on. Once you've done that, next thing is just do a high-level filter. Is anything in there that's obviously got a lot of carbon? Is there plastics? Is there fuel? Is there cement? Things like that. So that can help. And you might, with a simple traffic light, highlight it, red, amber, green, red for the high carbon intensity. The next step is doing a cleanup of the data. So anything you've been successful and have a column where you've got liters and kilograms and those sorts of things, that's primary data. So you can whip that out, put that to the side, and you can do that using an activity data calculations. Also set aside your top emitters, maybe it's your top 10 have a closer, deeper drill down on that. So that's your 80-20 rule. And then run up a consolidated set of accounts, and your friendly accounting clerk can help you with that. So take your 6,000 lines and put it into telecoms, put it into accounting, so you'll end up with about 20 or 30 spend items. And from there, it's just a matter of taking it through some calculations. So anything with primary data, do an activity-based calculation using the BIS factors. Anything with spend data, again, take that through the spend-based approach. And then out of scope, so that's the stuff that it's captured elsewhere. So for example, in your spend base, if you've got your electricity bill, well, you've already counted that in your scope 2, don't double count it. So note it, just keep it to one side. And then as you're doing those calculations, look for opportunities where you can use with your primary data, or maybe supplier specific for those top 10s, any environmental product declarations and such like. Same exercise again. Once you've done your scope 3, look at your current state, you've got your baseline, identify those quick wins, and start to engage with your stakeholders. Right, 3 simple tests for success is that when you're starting to look at your carbon reduction plans, what can you do? What are the initiatives? What's going to help you transition to net zero? There's 3 things you should ask. Will this activity reduce cost? Will it reduce carbon? And is it sustainable? I mean, sustainable to the business, so that the business will still be around in 5 or 10 years if it does this. And if the answer is 3 to that, yes, yes, and yes, then you're on a winner. That should definitely be a net zero project. So, in summary, there's no right or wrong way. The key is just keep moving. Progress is never a straight line, but using those simple formulas, 1 bite at a time, 80-20, do your first round of calculations, then by all means come and revisit it again for a second sweep, but just keep moving. So just finally, is that Achilles does a lot of work across all industries, all sectors, both here in the UK and Europe and globally, with companies enabling them to measure and manage their carbon. We've got a program called the Carbon Reduce Program. It's highly successful. We're seeing results of 30% reduction in carbon over 3 to 4 years. We're starting to now see 50% over 5 to 6 years, which is really, really pleasing to see, because we really do focus on those reductions and helping folks. So, if we can help you, do reach out. Happy to have a chat or even do a little health check with you if you're stuck on a particular problem. We're here to help. So, some Q&A. Mindful that we've only got a few minutes left. Feel free to throw anything into the chat. Otherwise, we'll be circulating an email if you'd rather send back to us a question in confidence. We're happy to respond to that as well. So I'm not seeing any questions come through, but that's perfectly understandable. Mindful, we've got a couple of minutes left, so I'll just leave it open for another minute. There's a hand up. So I got Georgia. Yes, happy to reach out. Wendy, I believe the slides will be sent out. Well, thank you, everyone. Thank you for your time at this lunch. It's been great, and hopefully that's encourage you to break through that planning loop and get cracking on. And if you need help, just shout out to us. Thank you very much, all.